Hello everyone, Edward here. In this video today, I'll be going over 3 basic investing strategies that you can use today. Spoiler, there isn't a right strategy, however, there might be one that fits your investing needs. So please stick to the end of the video to see which investing strategy works for you. In today's agenda, I'll go through the 3 basic investing strategies and I'll give the pros and cons. And then lastly, I'll let you guys know my thoughts and which strategy I personally use. Before we dive right in, I ask you to please smash that like button down below for the YouTube algorithm. Thank you. So we're getting to the first part of the video, which is dividend investing. When you buy some shares of a company, you may notice that there's a dividend, which is right here. A dividend is a distribution of profits from the company to their shareholders. An example here would be Johnson & Johnson. Just for context, for those that don't know, Johnson & Johnson is a healthcare company that owns a lot of brands like these ones right here. For every share you own, they give you 2.8% back every single year, which is actually divided into 4 quarterly payments. So if you buy $10,000 worth of Johnson & Johnson stock, then you'll be receiving $280 for the year, which is then separated into 4 quarterly payments. Simple, right? The point of this strategy is to actually live off the dividends, or you can actually use the dividends and reinvest it back into the stock. This is the power of compounding. And Albert Einstein once said that compounding is the 8th wonder of the world. If you understand it, you'll earn it. If you don't, you pay it. The companies that you should be looking for when you're using this strategy are really well-established companies, meaning they have a product or service that has been working for decades and a lot of consumers love it. Side note, there should also be a brand presence in these companies. Some examples would be McDonald's, Coca-Cola, P&G, Nike, Pepsi, Disney, and many others. If you notice, these companies has matured, a very strong brand, and they're bringing consistent revenue year over year. And this is what you should be looking for when you're using this strategy. Another advantage to this is that you can actually diversify and then preserve your wealth. So the disadvantages of dividend investing is that you don't actually have control over the dividends. Some companies can actually cut their dividend if they aren't meeting their numbers. If you look at the current situation with the Rona, you'll notice that many companies are cutting their dividends because they're not meeting their revenue targets. So note that dividends are not 100% guaranteed. Also, another disadvantage of dividend stocks is that they don't grow as fast as those that don't give out a dividend. The reason is because the companies are giving out money to their shareholders while they could have used that and reinvested back into the business. Warning, before you go out there and try to look for companies with really high dividends, the higher the dividend, the riskier the investment. You should look for companies that are giving out about 1 to 4% of dividends. Anything with a dividend that is higher than 6%, I would suggest to stay away from those. They will most likely cut their dividend, and I bet you that their balance sheet is very horrendous. The last disadvantage of dividend stocks is that if you want to live off the dividend, then you'll need very high capital in order to replace your salary with it. Let's say you want to make about $30,000 a year on dividends. Then you'll need about $1 million worth of a 3% dividend stock. So I do recommend this strategy for those that want to preserve their wealth and also try to live off the dividends, or they can also use the dividends and reinvest it back into the stock market. Now we'll get into the second strategy, which is value investing. This strategy was made famous by the Oracle of Omaha himself, Warren Buffett. This strategy is used to find undervalued stocks within the stock market, meaning the company is trading at a lower price than their real value. Remember, most of the time when you buy a stock, the stock might have priced in a lot of future growth. That means they aren't trading at their real true value today based on what they have. An example of this would be trying to buy a banana at a grocery store. You wouldn't want to pay full price for that banana, am I right? You will only buy it if it goes on sale. This concept is as simple as that. One famous method that Warren Buffett uses is a discounted cash flow calculator. However, I will not dive deep into this because this video is more for beginners. However, in the future, I may do a video on this. I just want to do an overview of what value investing is all about. However, if you want the simplest and easiest way to determine if a stock is undervalued or overvalued is by looking at the PE ratio. The price to earnings ratio will tell us how much the stock is actually trading compared to their earnings. The average PE ratio is at 15. So anything under 15 means it is undervalued, and anything more than 15 means it is overvalued. If there's no PE ratio, I would suggest using the price to sales ratio. This actually measures the stock price compared to their revenue or sales. A great example of value stocks at the moment are anything that was hit by the Rona, so mainly the travel industry, so airline stocks and cruise stocks. If you look at the stock price, they have plummeted because they're not making any revenue at the moment. If the Rona clears up and everything goes back to normal, these companies should be recovering and should hit their all-time high in a couple years. However, if the Rona prolongs, then I will consider these as a value trap, which leads me to the disadvantages of value investing. The disadvantages is that you might be looking at a stock that looks cheap, but there has to be a reason for it. And this is what we call value traps. Remember my banana example earlier? Let's say we buy this banana today, it is 50% off, but now it looks like this. This is exactly what I mean by value traps. On paper it might look cheap, but there has to be a reason for it. So a good example right now for a value trap would be Intel stock. If you look at their price chart, they are actually down right now, and you can see that their PE ratio is lower than 15. However, there's a reason all behind it, and if you did your research, then you should know why. If we look at this article here, we can see that they're delaying their 7nm processor until 2022. And as for me that knows a little bit about tech, that is actually a major problem. This is exactly what a value trap is. I recommend this strategy for those that wants to look for a deal in the stock market and won't pay less than the real value. And let's be honest here, who wouldn't like a great sale once in a while, right? And remember, this is what made Warren Buffett rich, because he only buys stocks that are undervalued. And a lot of investors actually look up to this strategy, so just keep that in mind. Now we'll get into the last strategy, which is growth investing. This strategy is for those that want a 2x, 5x, or 10x their money when they invest in the stock market. Note that this is the riskiest strategy of the three because you're not really diversifying as much and you're trying to concentrate to build your wealth. This is for those that actually have a very strong mindset and won't panic slow when their stock plummets above 50%. Not only that, vice versa, if your stock goes up 100%, you're not selling either because you're here for the long term. This isn't the happy, safe investing strategy, this is actually a roller coaster. For this strategy, you want to look for companies that haven't matured yet, meaning the company is still actually growing at the moment. An example would be investing in Apple all the way back in 2007, right when the iPhone was announced. It was only about $3 a share back then. Today, it is roughly at about 110. So imagine if you invested 90% of your wealth into Apple and you knew that they aren't going bankrupt anytime soon. Why wouldn't you want to put that money into Apple, right? The goal of growth investing is actually going to a stock before anybody knows the secret about the company. However, for this strategy, you must know all the ins and outs of the company. You have to convince yourself and other people on why the stock has a lot of potential growth in the future. If you cannot explain to me why you have a high conviction or the bullish case on the stock, then you shouldn't be buying the stock in the first place. Now here are the disadvantages of growth investing. So first, when you invest in a growth company, future products, services, or concepts are already been priced into the stock. This means that the stock is trading at future potential revenue, which is why many value investors don't like growth stocks because they're trading at crazy PE ratios such as 1000. If the company doesn't deliver on what they showcased and promised, then the stock will plummet. Remember this, it will plummet. And I'm not just talking about a measly 2%, 5% drop. We're talking about 20 to 40% drops. Let's say Tesla, for example, backed out of their robotaxi network business and they said, no, we're scratching that. You should be ready for Tesla stock to go down about 50% or even more. So you better be able to take those drops and not panic. I don't recommend this strategy for those that can't sleep at night knowing that they could lose all their money the next day. However, I highly recommend this strategy for those that are very young because you are able to still make some mistakes but learn from it. The best time to make mistakes is when you're young so you can actually recover from it and learn from it. Disclaimer, I am not a financial advisor. Please do your own research and your own due diligence before purchasing any stock. This video is for educational purposes only and the things I say in this video could be wrong. Now we'll get into the last part of the video, which is my opinion and what strategy do I use. Keep this in mind though, there is no right strategy because you could buy whatever stock you want. You could buy 3 dividend stocks, 2 value stocks, 1 growth stocks, it doesn't matter. At the end of the day, everyone has their own financial needs and their own growth that they want. This is mainly for beginners or average investors that don't know that there was a strategy when it comes to investing, so this is why I made this video. My strategy is actually the growth investing strategy, meaning I'm not diversifying as much and I'm trying to concentrate to build my wealth. As I am young, I have the advantage to actually go for this strategy and actually build my wealth to 2x, 5x, or 10x. Now we'll get into the bonus clip, which is tip of the day. And the tip of the day is to examine other investor strategies to polish your own framework and thinking. Remember, no one is correct when it comes to investing. Everyone has their own personal needs and their own personal financial goals. Identify first your risk tolerance and then identify what type of growth opportunity you're looking for in your portfolio. That wraps up for this video. I hope you guys learned something new today. Please hit the like, comment, and subscribe button down below, and remember to hit the bell notification. If I said something wrong in this video, please comment down below. I'm definitely not a perfect human being and I do make mistakes. I am currently still learning and growing every day when it comes to investing, so remember to be nice down in the comment section down below. Thank you for watching and I'll see you guys next time.